Hi, this is Linda Hitt. In this recording, we're going to do the financial reports, prepare a trial balance, and then do the income statement balance sheet, and then last the cash flow from the journal entries. So we're looking at the reports once again. The format's a little bit different. The good news is the balance sheet is still the accounting equation, so assets, liabilities, stockholders' equity, but we're going to have sort of clusters and groupings. Multiple step income statement, we'll make some comparisons and do some subtotals that we did not do before. So again, there's sort of a clustering of certain accounts for these comparisons. And the good news is the cash flow statement is pretty much the same format we've looked at earlier. All these statements are prepared to help readers, investors do evaluations of the statements. And so for analysis purposes, classified balance sheet will make some of the ratio calculations for these people much easier to calculate, and also the multiple step income statement provides more data. So let's take a look first at some of the changes in the balance sheet. Balance sheet assets are going to be broken down into various components. We are pretty much going to just use current and long-term, but in many companies the long-term is broken down further into subcategories. Current assets are those that are short-term in nature. They often are used up quickly in operations, or they become cash. Unless if you have a long operating cycle like your aging wine, then it won't be a year. But often for most companies, it's a relatively short period of time. So many of your assets are going to fall here: cash, accounts receivable, inventory, short-term investments, all would be within that section. The other section is for everything else. So your long-term assets would include equipment, buildings, land, things that will last a long time. Long-term investments could be in stocks and bonds. Maybe you bought a piece of land that you might build on later but you're not using now. And intangibles include copyrights, franchises, patents. They're usually rights or privileges to doing something. So we'll do the two clusters, do a subtotal, or total rather, for assets. Then we go on to the debts. What's due within a year or less? So short-term liabilities, many of the things: accounts payable, a one-year note, salaries payable. So much of what we have has been in the current category. And then long-terms would include 5-year note. We'll later talk about bonds payable. So we'll have more variety of that later. And then you do a total liability. Stockholders' equity, we're pretty much sticking with the same format: common stock and retained earnings. So next, let's look at the new format for the income statement. And you can see a definite difference. Now, again, it's still revenues and expenses. It's just a matter of that the order is changed. The U.S. rules do not require the multiple step, but it provides a lot more information for investors, and particularly also for the managers of the company. So your main source of revenue should be at the top. If you're selling a product, that's going to be sales, but if you're performing a service, then you'd have service revenue, and it wouldn't be as much detail. So you're taking the retail price of what you're selling and immediately comparing it to the wholesale price of what you're selling, which is the cost of goods sold expense. And then we do a calculation. So we have a general ledger account for sales. We have a general ledger account for cost of goods sold. They're going to both be on the trial balance, but the gross profit is simply one number minus the other. So markup on your goods is another name for gross profit. Companies really want to track that and see how they're doing, because if they don't have as much gross profit, then they're going to have to make up for it by cutting expenses elsewhere. Next, we have the day-to-day, normal, routine types of expenses: salaries expense, rent. Later, we'll talk about depreciation and bad debts. So you list those, total them up, and then you do another calculation. Gross profit less operating expenses will be operating income or income from operations. So we have general ledger accounts for all the operating expenses. We'll see those on the trial balance, but we're going to do a calculation to get the income from operations. So that's useful in comparing from last year, the year before, doing a time series analysis. Sometimes we also compare it to other companies in the industry. Then we have sort of a catch-all. If it didn't fit at the top of the statement, it's now under Other. Minor sources of revenue, so maybe you have a savings account, checking account, maybe you rent out part of your building. These are usually things that's not your main purpose for being. Assets, things like property, plant, equipment, sooner or later you're going to have to sell them and replace them, and when you do, we'll talk later about gains or losses, which are basically revenues and expenses. And also finance costs. They single those out under Other. Probably not so much that most companies do have them, but when we make comparisons between a company that has a lot of debt with one that has equity financing or common stock, by using income from operations, we can sort of leave out the differences in debt financed companies versus equity financed companies. And then we do, of course, our final total, which I know you've all experienced in other income statements. Cash flow still has the same three categories, showing inflows positive and outflows as negatives. Day-to-day running of the business is operating activities, so anything from customers would be there. And prepaid accounts would be supplies, prepaid insurance, prepaid rent. Those things usually are considered pretty much the day-to-day part. And cash paid for any expenses would be there. So you're listing and totaling. Investing is pretty much property, plant, and equipment, purchases and sales, long-term investments, and short-term investments. Financing, ways of raising money for the business other than operating, would include raising money from owners by issuing stock, raising money from creditors by borrowing. We do have the rewards to the owners, dividends under financing. And then certainly repaying loans would take cash out. And later we'll talk about treasury stock, which is stock repurchase. So you list the items total, subtotal for each category, and then what you hope to explain is what you knew already, is whether the cash went up or down for this particular period. And as accountants, we love to get things to balance and crossfoot and look nice. So at the very end, we have a little reconciliation where we take the change plus what we had at the beginning of the period, and it should equal what we have at the end. So there's no major change. What we will see is that we still can't use the trial balance to prepare this. We don't have enough detail. So we'll actually go back to the journal entries to get this. Okay, let's see if we can go right to our problem. And this is where we left off in the last video clip. We posted to the ledger. Hopefully everything is here. From the merchandising company. So all we're going to do now is create a trial balance. If you remember, the trial balance is simply a listing of all the accounts that you have and their balances. So assets usually have debit balances because that's what it takes to increase the account. So assets should be on the debit side of the trial. And these are still internal documents. Journals, general ledger, subsidiary ledger, trial balance. All internal, so you don't use these to go get a bank loan or do something else. It's the formal financial reports that you eventually take to others. So list the accounts that you've used. If you didn't use something, it has a zero balance, you don't have to worry about it. And I'm going to put all the assets together. It'll make it a little easier to do our statements. In a manual system, it kind of makes sense. And then I'm going to put the liabilities next, which I think, yeah, we have interest payable, actually, is the first one. Liabilities go up with a credit, so they're going to be on the credit side. Take the S off there. And notes payable, another type of liability. And accounts payable. And that's 33.0. Okay. And I think those are all the liabilities that we've got. So then we can come on down to the equity, stockholders' equity. So common stock and retained earnings I'm going to put here just to remind us about it. But as you can see, we don't have any yet. So we can do another video clip separately for closing entries later. And then we have our revenues and expenses, the temporary accounts. As I look out and see deer in our yard, hopefully they're not eating my garden. And so next we have, sales. And that's going to, of course, have a credit balance because that's usually what it takes to increase sales. And we have contra accounts. So here's where we show what we're tracking. Fingers are gone. And notice they have a debit balance. It's the opposite balance from the main account. So you would never present sales without presenting the contra accounts to go with it. Okay, and we'll see that in a minute, how that's presented. Okay, so we've got revenue and contra revenues. Now we're down to expenses. So cost of goods sold. I'm going to put CGS since I can't type. Expenses usually have debit balances. So there's the cost of goods sold. And we have not too many left. Freight expense, loss on inventory, account, I think I'll put the complete title. And we wrote it down because of the number of units were different. And then I'm going to put LCM expense for lower of cost or market expense, which is the weighted value inventory. So we had to write those down because the replacement cost dropped. And we have interest expense. And I think, hopefully, that's it. That's enough, right? Okay, here's interest expense for 100. And we would total up both sides. So I'm going to just do, I have the totals. Usually I would do an auto sum, but I don't want to pull up the toolbar again. So our two sides should equal. If they don't, then you scratch your head a little bit, spend 10 or 15 minutes, and go on, or look up the solutions. Okay, so here's your trial. Now we're ready to do the statements. I'm going to slide the general ledger off here, and we're going to do the income statement, the balance sheet, and the statement of retained earnings is really part of statement of stockholders' equity, changes in stockholders' equity. So let's start with the income statement. That should be done first. So temporary accounts, sales revenue would be at the top, and I've got 6,200. Okay, and then I'm going to say less sales, returns, and allowances. I'm just going to abbreviate. And I'm going to have a minus for that of 200. So I'll use Excel. And then less sales discounts. And that's going to also be a minus for the discount part. Okay, and then the next number, and I'm only using 2 columns. I could have set it for 3, but I think it didn't have much space here, so I'm going to leave it this way. So net sales is simply gross sales less the discounts and less the returns. I didn't show that as a negative. Okay, so our net sales, let me go ahead and just leave this up here so we can use it. The auto sum would deal with it since I've shown it as positives and negatives. So your net sales is $59.60. Useful information for a retail company because now they can see how well they're doing. They don't want a lot of returns, and they want to see if customers are actually using this time discount. From here, we want to compare that to the wholesale price of the goods. So cost of goods sold, which is an expense, singled out, is picked next. And we have that on the ledger, trial balance rather, here someplace. There it is. Okay, and we can show this as negative. Okay, so then we're going to compare the two, retail price of goods sold, wholesale price of goods sold, and that's what we call the gross profit. So I can just do an auto sum of those two. Okay, so this is an important subtotal which hopefully shows the markup on the goods. We can compare that to previous years and see how we're doing. Okay, and so from here we're going to do, we've got gross profit. Now we're going to do the operating expenses. the deer have left, but the phone rang. We have freight expense, so we can pick that up. I'm just going to, do that. And loss on inventory count is also something from day to day. Even though it's a loss, it's not loss on sale of property, plant, equipment. So we are going to pick that up. Most companies expect to have that. And even the lower of cost or market, that's part of the valuation, which is part of the day-to-day stuff. So we'll pick up the lower of cost or market expense, and then we're going to do a total, and we're going to add those expenses up. Okay, so here we have total expenses. Hopefully I've got everything included, but you never know. So now I'm going to compare gross profit and total expenses and get income from operations or operating income. And here I guess I can do an auto sum, gross profit, comma, I think I can do minus that. Let's see if that works. Okay. So I do want to subtract. So that's the subtotal from day-to-day operations. And then you come down to other, revenue and expense. Again, this is a catch-all. We don't have much to put here. We didn't do gains and losses from sale of equipment, things like that. We do have a finance charge, so I'm going to pick that up as 100. That's going to be a subtraction, but we could have had revenue, so you probably here want to show items as positives and negatives because it's going to be a mixture. And then your final thing is your bottom line net income. Can't get on the right keys today, so we can do auto sum, income from operations less other, or plus other if you have revenues. So $15.95 is my net income. Hopefully it's right. And now we're down to retained earnings. Because we haven't closed the books, we don't really have an ending retained earnings balance, and we need retained earnings for the balance sheet. So what we're basically going to do is look at what we have to start with, which isn't much, 0, and then retained earnings goes up for revenue, down for expenses, and down for dividends. We don't have any dividends, so I'm going to put it there so we can remember that. Okay, so this is a formal way to show what's going to happen when you close the books and retained earnings is updated. So we have nothing in beginning. We did the income statement first for a reason, because we need that to figure out ending retained earnings. We would then subtract dividends, which we don't have, and ending retained earnings then will be, I'll just type it in, $15.95. Okay, so now we have that ready to help us do the balance sheet. It's a classified balance sheet, so I'm going to start out with current. Actually, I'd put assets first, but I'm going to go ahead and show current assets. And then we're going to list all the short-term assets. So we've got cash, and I'm just going to type them. It's easier, I think, for me. Accounts receivable. Whoops. Let's go back and put them in order. Inventory is next, which is merchandise inventory for the complete title. Accounts receivable comes next. Okay, and those are all short terms. And then we'll have a total. So I can do an auto sum. And again, hope I've got everything. Looks good. And then the long-term assets, since we're not going to show all the subcategories, we're just going to call it long-term assets. Intangibles, property, plant, equipment, all that would come here. So we only have store equipment, I think is the title. Yeah. And because we bought it at the very end, we don't have any depreciation taken on it, so that's all we have for it. And we'll discuss depreciation later. So if I add, so store equipment basically is the total for long-term assets. And then if I add current assets and long-term, I'm going to get a subtotal for total assets. Okay, then we can go on to liabilities. Would usually have liability heading first, but I'm going to just go right to current. And short-term debt would be things that are due within a year or less. So Interest payable, actually it's a 3-year loan, so it wouldn't be due till the end of 3 years. So that's not short-term. Neither is the notes payable. So it looks like accounts payable may be it for us. And that balance $3,300. So if that's the short-term debt and you only have one, then that can become the balance. And then we can go on to long-term liabilities. And normally you have more short terms in your course than long terms, but here we have interest payable due in 3 years, and I guess I'll list it there for 100. And then we have the principal amount, which is notes payable, and that is 1,000. Okay, and then we can do a subtotal for that, and then we're down to total liabilities. So I can do the auto sum and get that. Again, if you're doing an Excel project, be sure you do all formulas for the statements. I'm just trying to do this without taking too long. So stockholders' equity, we know is common stock and retained earnings. Can't type either. Common stock from our trial balance is up here. It's 20,000. And retained earnings, we look at the statement of retained earnings. It happens to be equal to net income, but normally after the first year, you're going to have a beginning balance and you may have dividends, so it's not necessarily going to be equal to that. Do a total, add those up, and then to balance the balance sheet, you need one more total. So total I'll just put SE for stockholders' equity. Auto sum again. That's why sometimes throwing the totals to the right makes some of these totals a little easier. And of course what we're trying to prove is that the total assets do in fact equal the total equities. Creditor equity, owner equity. Or saying it another way, your accounting equation balances. Okay, so hopefully those are okay with our numbers. And we're done using the trial balance. If we're ready to do the cash flow statement, we're going to have to use journal entries. So we're back to the entries we did the other time. The only thing I did was to move the financing, operating, investing, FO and I to the journal entry side so we could see it. And we're just going to go right down the journals to find what we need to do. Operating activities, or just operations. Okay, so let's try this. We'll do customers, and I'm going to go ahead and show whatever I do add together. Let's find all the cash from customers. Okay, here's one. Maybe. No, this is cash out. We need cash in, don't we? So we are not finding any. Here's one. Cash and accounts receivable. Nope, that's a cash out too. I'm looking at the wrong line. Here it is. Here it is, finally. We got $1,000 from customers. In fact, I think the two entries are right together. I think that we don't have, yeah, once we get to the bottom of the adjusting entries, there's no cash. So we have two collections, one from Alice and one from Jim. So on accounts, they're both on accounts receivable. So I'm going to use $1,000 and $39.60. $39.60 plus 1,000, just to remind us. It would also include cash from unearned revenue and certainly cash that you receive right away from performing a service or selling a product. Okay, so that's $49.60 from customers. And then what do we have for operations? We had cash paid for inventory. So I'm just going to put inventory. And if we did more than once, I'm just going to put them all together. Okay, so cash paid for inventory is $9,800. If we only had the one, then I'll just take it off. Okay, so here's the one cash outflow. And we had cash for freight. Okay, here's another inventory one. So there's 50. Cash paid for inventory. Yes, that was the freight in. Let's do all the inventories first. And that might be it. Okay, I think it is. So we will put those two together. That's pretty straightforward. So let's do an outflow. I'm going to make sure they're negative. It's probably the most common error in the cash flow statement is to forget the sign. So we've paid out for inventory, and I think I saw freight expense somewhere. And it's right there. Okay, so we paid $70 for freight, or shipping, whatever you want to call it, minus 70. Okay, so that should be all the O's. It's 1, 2, 3, 4, 5 items. So 1, 2, 3, 4, 5. Okay. Hopefully we got everything, but you never know. And I didn't do this. I did this on a Word document. So let's just do the calculation. I'm not sure why I did it that way, but anyway. Whoa. Our cash flow isn't too good, is it? Minus 70. So this shows you what happens when you first start a business. That's why you got to have some resources there to start with, because it's going to take you a while to collect cash from customers, particularly if they are billed. So we actually have a cash outflow. More expenses paid and inventory paid, and not as much coming in from the customers, even though we had some pretty good sales. You know, we had profit on the income statement. Hopefully next time around we'll do better with the cash flow. So let's take investing. We don't have a whole lot going on here. There was only one thing we had here, was purchase of store equipment for $500. So that's a cash outflow. So again, we don't have to be wordy. We can just put store equipment. If it's an outflow, then we know we purchased it. If it's an inflow, we sold it. And then last but not least, investing. We have two up at the very beginning. So we raise money with owners. So we have common stock issued. So that's an inflow. And we borrowed money from the bank. So we could say borrowed money, or I'll just put notes payable. And that's also an inflow. So I don't think we didn't pay anything back. We didn't pay a dividend. So that's it. So we have a total, which is $21,000 inflow. And so when you put those together, net cash inflow, it's like we have more in than out. And then I'll just use this since, again, it's on Word. So I have a negative 4960, negative 500, positive 21,000. Now we wouldn't want to do this on a regular basis, is raise money with financing to offset the problems for the cash flow, but the operating part. But first year we're kind of stuck with it. Get it in the right spot. Okay, I think that's what we had. Maybe double check, huh? Nope, wrong one. Okay, there we go. So that's a positive cash inflow. And then if we really do the complete thing, we'd have plus beginning balance. Not sure why it's that little, but anyway, which is 0. And then it should equal the ending balance, which obviously would have to be 15,540. Hold your breath. If I go back to the ledger, which I think I have here, actually we can look at the trial balance too. We do have 15,540. We can see it here. And if we go back to the general ledger, then we see it here. So you really do know what the end result is. And that's what's so frustrating about it, is when it doesn't come out. There's so many possibilities for math errors. But remember, software does that part. We're more focused on the inputs and what goes on the outputs. Okay, so there's our cash flow statement. So I think we've got all 3 statements. And on the next video clip, we will deal with the closing entries and the final post-closing trial.